Welcome to our Finance for Housing Infrastructure webinar. I'm Cathy McBean, Chief Strategic Policy and Engagement Officer at NAIF here in Darwin in the Northern Territory. I'd just like to acknowledge the traditional owners of the country throughout Australia and wherever you're joining us from today, and their continuing connection to land, sea and community. We pay our respects to elders past and present. I'd now like to introduce our NAIF CEO, Craig Doyle, and our Chief Investment Officer, Stephen Land, who will be presenting for you today. Welcome, Craig and Stephen, and over to you, please, Craig.
Thanks very much, Cathy, and thanks very much, everybody, for joining us today. We do really appreciate your time. It's a great opportunity for us to give you an update on what NAIF does, but more importantly, in this very important area of social housing and accommodation, which we see as a major focus area for us going forward. I'm in rainy Cairns today, like Darwin. It won't stop raining here. And Stephen's in Sydney. I don't know whether the weather's like that down there. Look, for those who know about NAIF, I apologise. We're probably repeating stuff in these first few slides, but I think it's for the people who don't know us. I'll cover off very quickly about what our fundamental role is. So we're a Commonwealth Government gap financier. Gap finance is probably something you'll hear Stephen and I talk about as we go forward and what our role is. We provide loans. We always try to make it clear it is a loan. We do get questions a lot about grants, but we're not able to do that under our current legislation and mandate, so we're loans. And we're very unique. We're a catalyst for investment in the northern Australia. So just to be clear on that, it's the Tropic of Capricorn North. So it's about Gladstone on the east coast north, all of Northern Territory, and from just below Carnarvon north in Western Australia, which picks up the Pilbara and Kimberley and all that area. So that's the area where we can loan. Apologies if you're below the line. Hope you stay online. But yeah, that's the area that we operate in. Stephen will talk about later on, particularly in around this accommodation area. We have a higher risk appetite than commercial lenders. That's our role. And we can offer, and we do offer, concessional financing through a number of different ways, which we'll talk about later on, to facilitate projects. And as Stephen regularly tells me, what's the problem that needs to be solved, and we'll try to provide a solution to that problem if we're able to under our legislation and mandate. And obviously, we obviously need to make sure we do a risk and governance process for the money, but we are in that high risk space. So our role, for those who don't know, we have a $7 billion appropriation. As of today, we've lent just under $4.5 billion across just under 40 investment decisions worth around just under $20 billion of project value. So there's plenty of money left. And as I say, more, and I'm sure if we're using that money across the north, that won't be a problem. We're relatively young. We've been around only since 2016, and it's probably only the last 3 or 4 years where our mandate has allowed us to do more things in this space, which is something we'll talk about later on as well. And as I said before, we're focused on economic growth, jobs and Indigenous outcomes. We'll show you the 5 main criteria shortly. And we're a key part of the federal government's 20-year plan. We've been named in the Future Made in Australia initiatives. We play a massive role in the critical minerals strategy as well. But today we're going to focus mainly around the accommodation social infrastructure area. So for somebody, for what we do, we have a pretty broad mandate. There's 5 key areas. It's got to involve the development or enhancement of infrastructure as part of our loans. So just so you know, we cannot fund the purchase of land. That's not counted as infrastructure in our mandate. We can do all the other infrastructure that's above that. We can do refurbishment of assets. It's probably sort of in that higher category of refurbish, not just a lick of paint. And we can't refinance an existing loan. It's not somebody goes and loans money from a commercial bank or someone else, and then somebody comes and wants us to refinance that. That's not what we're allowed to do either. All our main aim is to generate public benefit, jobs for the communities the loans and the projects are located in. We've got to provide significant benefit. It's a key part of our measurement criteria when Stephen puts an investment decision to our board. It's not something to be scared of. We're very proud of it. We're the only special investment vehicle that the proponent needs to have an Indigenous engagement strategy with the traditional owners on where that project's going to be located. And we're getting great results out of that team, and we have a dedicated team in-house to help facilitate that project. And as I said before, the proponent has to be able to repay, or sometime in the future, if they wish to, refinance our debt as part of our criteria. Look, this is a really heavy slide, and it's on our website, and I think it comes up on our website one at a time. But this is the projects that across Northern Australia that NAIF has already invested in. So these are investment decisions. Quite a few of these are already in operations. Many are still in construction. So you'll see there's a very wide spread. In terms of sector, we're sector agnostic. We can do any type of infrastructure, basically. And we've got significant coverage in the resources, critical minerals, rare earths, airports, renewable energy. Our biggest project is a $610 million loan to the Kidston Pumped Hydro Project in regional Queensland. We can do agriculture. And as we're going to talk about today, we also are now getting into this accommodation space. Stephen and I will talk about that at length, a major project that we've just invested in that is in construction up here in North Queensland. But also to let you know, a couple of years ago, NAIF also invested just under $50 million in a dedicated student accommodation facility at James Cook University, which is a 400-bed facility. And that's also running very well, and my understanding is well over 100% occupancy. So we have had some exposure, but we're moving and our scope in this space, which is something we want to talk to you today about.
Well, welcome all. Great that you can join us. So just to give some context around the base of this webinar, I mean, not unknown to all that there's a big problem with housing across Australia. What we're seeing is that in Northern Australia, this is accentuated. So the map on the right shows you the proportion of affordability stressed households by the local government area. The darker colour is the ones that are more highly stressed, so between 60 and 100% of households are stressed, and you can see there's a concentration in Northern Australia. So, very much a problem within our region, and one that we're very focused on trying to resolve. So there's a few issues there around the context. I guess what we're seeing is in capital cities, there's significant stress, but that is just more accentuated in regional and remote areas. Those areas are well known, so also I won't go over them too much. But what it does show is that there's a number of issues there that NAIF can actually address through the risk appetite that Craig mentioned. So where there's a project that has risks associated with Northern Australia, we're able to take a higher risk position on that. And some of the key ones we're seeing there, I mean, construction cost is an issue all across Australia, but accentuated in the north. Insurance is another key one. Obviously, it's much more subject to natural conditions, whether it's natural disasters or just over time, increased wear and tear on accommodation. So insurance is harder to get. Increase the cost of projects, and also just the fact that within Northern Australia, the higher requirements. So you've got to build for cyclone rating, therefore that's an increased cost, stretched logistics. So there's a whole raft of factors which all build into the fact that Northern Australia, and particularly across our region, has got this accentuated issue around housing. We'll talk more about it going forward, but you can see there that pretty much every factor that's involved in the construction of accommodation is accentuated in Northern Australia, and therefore they're all factors that we need to look at and try and address through the ability of NAIF to fill that funding gap. What we'll talk about over the course of this seminar is really just how these issues, everyone's got to come together. We've obviously seen that in the past the approach that's been done hasn't worked, hasn't really addressed the problems. And it really is a requirement. It's a sort of multi-pronged approach to resolving this. I mean, what we've seen, we'll talk about the project a little later on, is that everyone had to come together, everyone had to contribute, and everyone had to, give something. So, there's a whole raft of partners that are involved in the development of property. You've also got local council, you've got the developers, builders, provision of infrastructure, the finance, which is a key one, and the one that oftentimes people underestimate is just that long-term facilities maintenance. So, if you're building a project that's got you're looking at, say, a 20-year life cycle, you've got to make sure it can be maintained. And that's a big issue in Northern Australia because of the remoteness, stretched logistics. So, one of the key factors that really helped that Cairns housing project was the ability of, in that case, a community housing provider to come in and take that risk. And, we'll talk a bit about risk allocation later. But it's really about making sure that the people who can best manage that risk are allocated it. And, it shouldn't be underestimated that without everyone coming together and giving something, these projects just won't get developed. We'll talk a little later around, the way that the cash flows work. But you'll see that governments are a key part of it, or corporations who can provide, long-term leases to help underpin that support. Obviously you've got compliance with regulations. As I mentioned, cyclone ratings are a big one in Northern Australia and really contribute significantly. So what we're seeing is that a region which has got probably more stretched socioeconomic conditions is also the one that's got the higher costs through labour, building requirements, and insurance. The state government's also got a really important part to play. We'll show later how the Queensland government was involved in the Cairns project, but really providing some form of whether it's an operating subsidy or providing long-term leases to underpin the cash flow of these projects. So in terms of the partners on this, we'll talk about financing here. Look, innovation's critical. As I mentioned before, what's been done in the past hasn't worked. Hasn't alleviated the issues that we're seeing around accommodation, and therefore, people need to think outside the box. The old models clearly aren't effective, and what we're really looking for now is to see how innovation can be brought to bear on this problem. Two key ones that I'll just call out on this slide rather than going through the whole thing is around the community housing provider, the facilities maintenance aspect, and in other areas it may be somebody else, but somebody who can come in, it can make sure that the facilities are maintained to the required standard, that there's not over wear and tear that's above what's forecast in the model, and also to make sure that these are providing amenity to the users that's expected. So that could be whether it's social and affordable housing, could be work accommodation, it could be just regular accommodation. But it's really important to note that the climate in the north is tough. The wear and tear, if facilities aren't maintained, their lifespan's shortened, and particularly in the case of private sector involvement, the capital value of those projects or individual dwellings can be eroded. The other one to talk about here is also around this, the banks and government lenders. Craig mentioned earlier around NAIF being a gap financier. As a gap financier, we're really there to provide a solution, but also to help crowd in the private sector. And in order to do that, we've got a whole range of tools that we can apply. I think unlike, say if you went to a bank, banks develop products and then sell products to users. We're at the other way around. We actually look at what does a developer actually need, and then how can we try and fill that gap. So we've got a raft of tools that could be around increased tenor. It could be around interest capitalisation or repayment holidays. It can be structural subordination. So we'll actually sit behind a commercial lender in these projects, but rip capital gap and address the fact that ultimately, everyone needs to make something out of these projects. So developers need to get a return. Banks obviously need to get a return as well. And we've got a lot of flexibility there. So in terms of the partnerships, it's really important. And we're just one of the special investment vehicles. So there's others you can also deal with. Probably the thing I'd really like to convey to people is come and talk to us. We're incredibly flexible. Even if we can't actually provide financing to you, we've got huge experience across Northern Australia from the number of projects we've looked at, and can certainly help support your business case around what's required, who can help, some of the key issues to address. And we frequently speak to people who we raise concerns or issues that and they go, oh, hadn't thought about that. So even if we're not able to provide the financing, the fact that we can help support you in identifying issues, factors to be aware of, is something that we think also brings a lot of value to the table. As you can see, there's a whole raft of things here. I won't go through all of them. I'm sure you can read while I'm talking, but just want to probably pull out a couple of key issues, really focusing on this high risk appetite we've got. One is looking at the regulatory compliance, the building codes. We frequently hear around just the code requirements in Australia, like everywhere else. Over time, those codes evolve to reflect conditions or events that have occurred, and particularly in Northern Australia with weather conditions, these codes have largely been increasing, and that also increases the costs. So high costs as a result of that is something that we through our risk appetite statement, and as Craig mentioned, we're well placed to support that. Look, project management, really important. Northern Australia it's a different environment. It's not like working in a big capital city in Southern Australia. You've got much more remote projects. You've got stretched logistics. Oftentimes you've got your reduced availability of services or infrastructure. So having a project manager who's used to working in Northern Australia is a really key part of developing a project effectively. And, that's something that we always talk to proponents about and really provide our feedback on. And, we're very keen on doing that. You'll see the financial structuring. So as I said earlier, we've seen that, what's been done in the past hasn't worked. Oftentimes what works in Southern Australia doesn't work either. So it's around developing a structure which is able to be delivered in the north and get the project moving forward. And the Cairns housing project is a great example of that, where it's an unusual structure. It's not something that has been seen previously, but as a result of all the parties coming together, and that's ourselves, it's Housing Australia, one of the commercial banks, state government, community housing provider, project developer and contractor, who all sort of came together to come with this innovative structure. We're able to deliver this project. It's 490 dwellings, over 600 people are going to be accommodated in accommodation. This wouldn't have occurred without everyone coming together and thinking outside the box in terms of how we can bring the various components to bear, what each party can bring the transaction, and doing something outside the box. Insurance, I mentioned earlier, really big issue. Insurance premiums are rising everywhere through weather conditions. That's accentuated in Northern Australia and increases the cost of the project. So again, it's something that we can consider as part of any assessment in terms of whether we can provide some form of concession to help offset that, or come up with a different solution around those insurance projects. So again, please come talk to us around any issues that you want to talk through. Even if it's just around early stage development, very happy to have a discussion around that. You don't have to be sort of shovel ready to come and talk to us. Really just in that development stage, coming together, trying to work out what the project looks like. We're all very available.
Thanks, Stephen. And look, our Cairns housing project, which we're about to give you a bit more information on, is, we understand, to be Queensland's largest modular housing project and one of the largest in Australia. I will say is we're fans of modular, and I'll go through some of those on the screen, but we're also fans of conventional build and anything else to do with accommodation or remedying what is a major problem across the whole of Australia, but particularly in Northern Australia, with vacancy rates and availability of accommodation for different people. We can look at social, affordable, we can look at conventional. It's something, Stephen mentioned, come and talk to us about. The Cairns housing one is build to rent, but, build to rent, build to sell, or a combination of both. We can look at all those sort of things. So, please reach out. Look, what we've found with modular housing is the Cairns housing is obviously a large project we'll give you more detail about. We're getting a number of other inquiries where modular, speed to market, the fact that you don't need as many trades on the site to put them together. These sites are very remote, have trouble with trades at the moment. Maybe that'll change. The cost efficiency is a major positive with modular, adaptable designs within reason. And I think, in fairness, when Steve and his team came about a year ago and said, we've got this Cairns housing project and it's modular, and showed us some renders, pictures of it, I didn't believe it was modular. I'm sure a lot of people on the call know this, but it has come a long way from the old ATCO hut on a mining site. It is very high quality modular design that's on offer now, both within Australia and elsewhere, and it's very, very impressive and how fast it's moving. So we think there's a definite opportunity in certain areas of Northern Australia where this could make sense. There's a project we're looking at, which I won't name, that has potentially a conventional build for the first 3 layers, including a car park and some commercial retail. Then they've put modular on top of that. So there's different models we can look at and talk to people about. The impact on housing in terms of, the Cairns one, for example, is nearly 8 or 10% of the requirement for beds that are vacant in Queensland, in Cairns, sorry. So it's very quick to market. I think to get this right, from go to woe, from first bulldozer on site, you're talking less than 2-year build, and that's allowance for, a couple of wet seasons. So you can actually get very quick product to market that is high quality. The Cairns one also, as Stephen mentioned before, cyclone rated, fire rated, and basically the same standard as conventional build in terms of all the regulations and requirements. So it's something we're very interested in, but I will comment, we're more than happy to talk to people about more conventional builds and other options as well. So the Cairns project, I should have said the slide a couple of slides ago that Stephen gave was a render of the actual project. So is this one. So it's a 3-story building. 490 dwellings, 1 and 2 bedroom apartments, just over $400 million. It's a mix of 245 social dwellings, 20 odd of affordable, and a few NDIS STA projects. So it's a little precinct. So there's 3 different precincts in one. It's on the old drive-in site of Waree, for those who may know Cairns, very well set up and where it's located and everything else. And as Stephen touched on, and I'll re-emphasise, we are very confident that no accommodation project in Northern Australia is going to get up by one person solving the problem. And it definitely won't just be NAIF. It's about the Queensland and Territory governments. We're talking to them about the model that's been used here. Housing Australia played a role. Hopefully they'll play a role in more projects, whether we're involved or not. The private market, in this case, ANZ, came in and were very, very accommodating in terms of putting what they could do in this project together, along with what we could do and what Housing Australia. And the Queensland government, as Stephen mentioned, a major, if not the major player in terms of a 20-year operating subsidy that guarantees a portion of the revenues. Without giving you detail, our loan is 20 plus years to make sure that this project gets up. We're in it for the long haul, and we're all about the outcomes and the jobs and what it can provide. So a very exciting project. It's Australian-made modular, in this case, Victorian. We couldn't find anyone in Northern Australia who could manufacture this one, but Stephen would be more than happy if someone wants to come and talk to us about building a manufacturing facility in Northern Australia to build modular equipment and materials. More than happy to talk to you about that as well. And as I say, FCC construction and Modscape are on the side, and then the Tetris and the commuting housing limit are key players in this. There's no use spending $400 million to build 490 dwellings, and then it's not maintained, not well run, and it's not a place where people want to live. So it's a key that the people who are involved to run the operations and get the design right. This is 3-story with lifts. Everything else is there. Very, very important to get to the whole mix.
This just give you a bit of a general view of the way this project was developed. But I think, there's some key takeaways here, and, really comes down to that whole ethos around, working together, everyone putting, a bit extra in. So, you look at a regular housing project in Australia, bank will lend you on an LVR basis and equity makes up the rest. That's been tried and tested across Australia, for many, many years. What that isn't doing is delivering housing in Northern Australia. The commercial bank appetite is limited. The equity returns expected are higher. And as mentioned earlier, the construction costs are also higher. So when you put it all together, it just makes projects unviable. And hence we just haven't seen the development of projects or accommodation in North Australia like we should. So to give you some idea of how it's different, looking at the capital stack here, ANZ came along. They're doing the construction debt alongside NAIF. So we're working together on that. Then during operations, Housing Australia will come in and also play a part in that. But the other bits of the capital stack which make this stand out is the HIF capital grant. So HIF's the Queensland Housing Fund. They've come in and given a capital grant to help contribute to the construction costs. Also, Housing Australia have put in a capital grant, so also, contributing those construction costs, and obviously we've got equity at the top like elsewhere. But what that's done is reduce the amount of equity required in this project, and therefore made it viable. So that gets you built, but then as Craig said earlier, you need to get repaid. So in terms of the ongoing revenue from the project, that Queensland operating subsidy makes up a large portion of that. And without that operating subsidy, it'd be very, very difficult to develop a project like this. And obviously, depending on where projects are located, the subsidy might be, larger, smaller, provided differently. But I think without the provision of some form of government support or, large corporate support, these projects are just very, very difficult to move forward. Financiers need certainty, investors need certainty. And it's a very different market in Northern Australia. Boom and bust. So in the good times, everyone makes money, makes hay, and then in the bad times, things turn very poorly. So you need that consistency of revenue stream really to get these projects moving forward. As Craig mentioned, there's also some market parts. So we've got some affordable housing and social housing, and also some disability revenue on the top of that. And I think this is an area where, depending on the makeup, we can be very flexible in terms of trying to address, particular shortfalls or particular issues. And that's one of the great things. I mean, I love my job working at NAIF because I do have that flexibility. We're not like a lot of other bodies who have, very fixed, credit policies or, particular products, and, they push the product. We're really, we work the other way around, well, okay, here's what's, we're trying to solve for. How can we try and fill that gap? And, having that flexibility really assists us in helping to deliver outcomes in Northern Australia. So I think we're using Cairns as a great example of a large-scale project that has delivered, some really fantastic outcomes for Cairns and the inhabitants up there. Why has this model worked? So I think, the long-term focus is a really important part of this. This long-term operating subsidy is what really underpins the whole project. And the fact that everyone's looking for the long-term has helped to, get the project to a stage that got it to be executed on. So, it's Northern Australia, and particularly in sort of, more remote and regional areas, is not an area that you can just sort of, put up a development on the, build and sell it and get out. It's a really different market. And I think the fact that everyone had this very long-term focus was a critical issue in getting that project moving forward. Mitigating the risk, mentioned earlier, obviously facilities maintenance is a big risk over the long term. So having a provider who could come in and wrap that risk was crucial. The low interest loans, everyone loves a low interest loan. We are a loan, as Craig mentioned. There's no grants through NAIF, but there's a whole raft of other bodies who can also contribute to that. So Housing Australia, that's their bread and butter. But there's also other bodies, and I think every government's got an intense interest on this. So we may well see different products evolve over time. Probably worth mentioning the scalability. So NAIF doesn't have a formal minimum size, but it is very difficult for us to get involved in very small projects. So, we sort of, think about, that sort of, $10 to $20 million as being probably the lower end of the spectrum in terms of the loan size, that is, not project size. But again, we're always happy to talk to individuals or consortia around, what we can do to help deliver. And if we can't help in delivering, we're also very aware of what's available across government, so we can make referrals or support people in that application. But I think probably the key takeaway from this is it is around risk sharing. Everyone's got their piece of the pie and the things that they're specialists in. Give them the various segments of each project rather than trying to get someone to wrap the whole thing, because it's very difficult. It makes projects much harder to get up and running. And particularly in the north, because of these unique factors, without specialists, it's very hard to get that risk mitigation to a level at which projects can be successfully delivered. So.
Thanks very much, Stephen. This is the last slide before we look forward to answering your questions. I think the key messaging from all this is, look, and Stephen said before, it doesn't cost anything to talk to NAIF. Come and talk to us. Just know if it's sort of, just an idea in your head and there's no pre-work, it definitely won't be ready for us to get into our, real due diligence or talking to our team, but happy to have a chat anyway as we get through. We always say it's easier for us if people talk to us earlier rather than later. So that's the thing. Look, in terms of accommodation and housing infrastructure, acquiring and developing ready land, it's great to come to a project, but if you don't have access to the land, happy to take it offline about what we'll accept in terms of freehold versus long-term leasing and so on else. We've got different views on that. It doesn't have to be necessary freehold. The stamp duty, which Stephen touched on before, stamp duty and insurance and property transfer is always very important to understand that. And obviously local government, knowing about local government planning rules and everything out, which is pretty standard, and most of the people on the call will be familiar with that. And I think Stephen touched on it well with the Cairns housing. For us, it's around making sure that there's offtake. We will take a higher risk on the revenue side. but we're also a financier playing with taxpayers' money. So we will look at that, and we're getting a lot of interest from a lot of accommodation providers across the north already, early stages, where you've got state entities, potentially local government entities, some federal agencies who are willing to sign up for 10-year leasing agreements to use that apartment for their staff and things like that. That's something we'll definitely talk about if you talk to our team, in terms of understanding where that revenue side might come from and how much can be locked away at time of investment decision, understanding that 100%, if it's 100% locked away, they probably don't need NAIF. Probably the commercial banks might be interested, but we're not seeing too many of those in the people coming to talk to us. Thanks, Stephen.
Thanks, Craig. Look, this whole long-term revenue streams is important. I think what we're seeing is that probably a combination of short-term development profits as well as long-term leasing is going to be the model which ultimately evolves in Northern Australia. So I think we're also seeing not just with the government sector, but also the private sector. Clearly, businesses up there need long-term accommodation for their staff, whether that's mining projects or other projects. But without that accommodation, it's a bit of chicken and egg. And you can't get projects moving without accommodation to put people in, and you can't get accommodation built without projects to provide the funding. So I think as the market evolves and government policy is certainly extremely focused on this space at the moment, you'll probably see a combination of that. But, it is that longer term lease or operating subsidy which will get these projects moving forward. It's very, very difficult for whether it's ourselves or other financiers to take a short-term view on market rentals because there has been historically quite a lot of volatility in the north in these regions. So something certainly to be considered. Look, housing is absolutely critical infrastructure. It's constraining development in the north because there just isn't much of it, and what accommodation there is often older, not very high quality, not providing good amenities, so that restricts the number of people who are prepared to move to the north. Particularly people who've got families. As that builds out, I think it become a virtuous cycle where better accommodation and amenities leads to more people moving there, which will then help to support that market. So, from NAIF's got two key imperatives. One's around economic development, the second one's around population growth. Housing clearly fits both those boxes perfectly, and something that we're very, very keen to support. We do have a lot of tools available to us. We've got this higher risk appetite. There's a whole raft of features we can bring. So because housing does drive straight down the fairway in terms of our mandate, it's probably the area that we can bring the most support to in terms of providing concessions and support. And then around these operating subsidies and grants, look, it's well known that government's setting up various bodies. The HAF is the largest of those around providing these subsidies and grants. To date, there's probably been more focus on Southern Australia, just given that's where 95% of the population live, which is what it is south of the line that we cover. But I think as over time, as the government sort of focuses more on the north, so defence has got a big push to the north. Clearly we've got a number of white papers and other documents which says that government policy around developing the north and bringing more people there. There's probably going to be scope for more subsidies and grants to help support that. But again, if you come and talk to us, we can certainly give you the latest state of play on what's happening in that space. We do keep very close to various government bodies, whether it's obviously state or federal level. So we've always got good intel on what's happening there. But really a big issue in terms of developing Northern Australia because of this higher cost and lower economic growth issue that we've faced into for many years, and NAIF was actually set up to try and overcome. So definitely priorities there around housing. We do see it as core infrastructure. It's absolutely an enabler for Northern Australia to get population economic development going. So we're very keen to speak to proponents who have a project and provide our input and support. So I'll leave it there. But
so we'll go to some questions now, and I'll just remind you to put your questions in the the question area up on the ribbon on the top of your Teams, you'll see a little icon with a little question mark. So if you want to drop your questions in there, we'll be taking some of those live as well. We have had some come through earlier, so I might just run through those quickly, Stephen and Craig, with the first one for you, Stephen. Given we are proponent-led, who is eligible for NAIF finance and who is eligible for the Northern Territory infrastructure loans? We might need to do a bit of an explanation on those as well. So how do you get a NAIF loan? Is everyone eligible?
Thanks, Kathy. Yeah, so look, NAIF is sector agnostic. As Craig mentioned earlier, we can only provide loans for the development or augmentation of infrastructure, which housing is clearly part of it. So we can't provide financing for land. But otherwise, essentially there are no exclusions from who's eligible. It's really making sure that whatever project can meet those management criteria that Craig laid out. I think that the fact that everyone's got to have that user engagement strategy is absolutely crucial, and providing economic benefit more broadly. But otherwise, anyone can come along and as long as they can demonstrate that they can repay or refinance our loan, that they can become eligible for it. So if people are unsure or want some clarification, I suggest that they get in contact. We've always got people ready to get on the phone and talk through your project and give you guidance around what we can or can't support, and if we can't currently support it, what you can do to that project to make it eligible. But it's a very broad mandate. So I think for the vast majority of people, provided they can meet that as management criteria, they would be eligible. In terms of the operating revenue of a project, that's probably the key one. It's very difficult for us to finance projects which rely on market risk. We do like to usually see an element of contracted revenues within those projects to help support that. But in terms of the NT infrastructure loans, it's an interesting model. So the way the model worked was NAIF provides funding alongside the Northern Territory government into a fund, which then has its own investment criteria to look at smaller scale infrastructure. So it was really set up to address the fact that NAIF was really built to do large scale infrastructure, but a lot of projects, particularly not across Northern Australia, are smaller in scale. So I believe they've just approved their first project. It's a green project. But we are definitely looking at how we can help support smaller projects there. So if you come to us and it's not a project for us, we can definitely make referrals to that NT loans program.
Thanks, Stephen. The next one's for you. Do builders and contractors require federal work health and safety accreditation to undertake NAIF-funded projects? And does this vary based on the project value, or is it a holistic accreditation required for all projects?
Yes, under the legislation, any project which has a contract value of more than $4 million is required to have WHS accreditation in order to be eligible for Commonwealth financing, which in our case is I guess largely every project. We always say to people, it's a key issue, particularly in Northern Australia, where you might have a number of smaller contractors working on a project. Either you need a lead contractor who has accreditation who will effectively wrap that, or each contractor needs to have that accreditation. It's not that onerous to get it, and I think with the increase in government contracts in Northern Australia, a lot of contracts would certainly benefit from going through the accreditation process. It works alongside, I guess, the legislation. So, every contract has to comply with WHS legislation in terms of workplace safety, etc. And this is probably it's more an auditing process to just demonstrate that they've got the processes in place to ensure that they are complying and they can demonstrate that they're complying. So, but I guess the short answer is yes, they do need to have that accreditation.
Okay, thank you. And another one for you. There are a number of Aboriginal and Torres Strait Islander communities across Northern Australia. Can these communities access our finance when considering their capital housing project funding mainly comes from the state or federal governments? How do they tap into NAIF?
Yeah, absolutely. NAIF's just a part of the policy around Northern Australia, so we can work alongside whether it's state or federal other funding bodies. So absolutely, they can come and talk to us. As we've spoken over the course of the seminar. We're a gap financier. We're really there to sort of see, well, what other forms of financing are available, and what's the missing link, and try to be that missing link. So I think in terms of these projects, absolutely come and talk to us. We will identify if we think we can add value. But there's no formal exclusions from NAIF involvement in those bodies. It's really just a case of making sure that the project can meet all of our managed criteria. So,
okay, thank you. Craig, one for you. Can you just reinforce the area that we cover and maybe touch on a little bit about how we're proponent-led? There is some conversation in the chat about some of our projects seem to be in quite wealthy regions, a la the Pilbara or Gladstone area. So maybe that is a bit about how we're proponent-led, so we really don't get to decide that, but also the region that we cover.
Yeah, thanks, Kathy. And those wonderful little maps in the top half of Kathy, Stephen and my backgrounds is it. It looks a bit wobbly, but it follows local government boundaries. That's why it looks like that. And I think I said at the start, all of Northern Territory, basically from Gladstone north in Queensland and from just below Carnarvon and the West Coast. It is a legislated line. We have had requests. Somebody asked me whether Launceston was close enough. Unfortunately, I'm sorry, it's a bit low. But yeah, look, it's a legislated line. So that's where we're bound. We'll set up specifically to recognise the difficulties in Northern Australia to get key infrastructure projects up. We also have now the IoTs added on a year or so ago. Only a small little place in the middle of nowhere, but we're very keen to make sure it's what a fantastic place that is. I think all three of us on the screen have been there. But yeah, we've also got the IoT, so we're looking to see what we can do there. And to Kathy's point, we are proponent-led. We'd be just as happy doing a project in a community of 300 people as we would in a community like Townsville with 200,000. If it's anything in our Northern Australia footprint, please see us. We haven't got quotas. So I spoke at a Western Australian conference last week, and they said, you're giving too much to Queensland, give it all to us. We don't have quotas. I think the last three have been Queensland, but we could have three in Northern Territory. Every project we treat on its merits. When it comes through, we will deal with it. We don't have allocations so when in regions. So just please come and talk to us if you think there's a project we can help with.
Yeah, thank you, Craig. Stephen, the next one's for you. Do you have any thoughts on financing for mixed-use developments, e.g. apartments with retail and commercial components to them?
Thanks, Kathy. Look, we look at every project on its own merits. We don't have set criteria or set guidelines. We really look at what's the project being proposed, what's the makeup of the revenue stream, and what's the benefit being provided. So in terms of would we can we look at them? Absolutely, but it'll really come down to the nature of that revenue stream. So how long are the commercial dwellings, commercial spaces leased for? Who are they leased with? What's the makeup of the accommodation side of things? We will look at all those kind of projects, and we don't. I guess unlike a bank who just goes, we'll do 50% or 60% or 70% LVR. We don't look at it that way. We look at it much more from a cash flow perspective. So if I could sort of pass on to people on this call, don't feel constrained because you might not have the right LVR. The focus is much more on that revenue stream. So we've certainly we've got projects in the portfolio with really very, very high gearing, but that gearing's been attainable because we've got very, very strong cash flows for the project over time. So that's something that does sort of set us apart from the commercial market. And particularly in the north, is something that we think may well help us to support development up there. So, if you've got a mixed-use development, please come and chat to us.
Yeah. Okay. Thank you, Craig. How does NAIF assess public benefits into projects?
Yeah, thanks, Kathy. Great question. It's a key criteria for us, and I know something the board looks at very closely when we make our decisions. We're not looking at margins and equity returns. We're a concessional generally a concessional lender to get the project up based on community and Northern Australia benefits. So if you make it through into our due diligence stage, we'll be asking an independent party to do an assessment of public benefit, reputable company. We don't make it up ourselves. We do have someone dedicated in NAIF who does this and works with Stephen's team and then others to calculate that. That is something the board looks at very closely when we make an investment decision. And very pleasingly, I think we're one of very few that now is looking at actuals afterward. It's all right to say at the start of a project in investment decision, it's going to generate, at the moment, we're running at $8.70 for every dollar we lend. So we're running about 9 to 1. How do we know that? We measure it. But now we're also going back after the event and measuring whether those benefits were real as well. So we've spent a lot of time on a framework so we can recheck ourselves, make sure our modelling and that of our independent party is right so that it's a true representation of benefits. I will say as well, something like the Cairns housing project only had a loan to public benefit ratio of about 1, but we only measure public benefit to Northern Australia. So when you see our numbers, they look really high. That's only Northern Australia. Remember, the Cairns housing is going to be built in Victoria. So the benefits of that 400 million construction or whatever the component is for those modular, those materials, we don't measure, but we know it's a benefit to Australia. We just measure what's in Northern Australia. And there's other benefits as well that can't be quantified. We also add that to our board pack to make sure the board understands those as well.
Yeah. Okay, thank you. Stephen, do you have any advice on how organisations or projects can crowd in private sector or equity investment?
Sure. Thanks, Kathy. Look, I mean, that's really what, one of NAIF's, key strengths is, and that's that crowding in. So, we can help to de-risk a project, and by de-risking that project, that helps to attract, private sector involvement. So whether that's commercial banks joining the project at a senior debt level or helping to get equity involved in the project as well. The fact that we can help de-risk and the way that we can do that is through our mandates. So helping to address some of those unique factors to Northern Australia that other parties may not be able to address. We can take that risk out, reduce the risk of the whole project and therefore attract private sector capital. So in terms of how can proponents do it, I think probably the starting point is to come and talk to us about whether we can get involved to help take on some of those risks, whether it's through the capital stack or also providing guidance on contracting, etc. Because it's really around getting a project to a stage at which investors or the commercial banking sector are comfortable with the risk profile of that project, and that is really what NAIF's supposed to do. That's what a gap financier does. It helps to take on some of those risks and make it more palatable for the private sector. So.
Okay, thank you. Craig, are there case studies or evidence on overcoming issues of government-owned housing in regional areas distorting the market, i.e. incentives for government staff to buy? What are your thoughts on that?
Yeah, really good question. And to be honest, it's probably something NAIF hasn't had a close look at. We take the project on its face value. We are seeing a lot of projects coming through to Stephen's team in the early stages talking about it's almost the opposite, that the government employees are more likely with the people they work for in the state, federal or local needing accommodation and probably looking to sign up on that offtake, some certainty on that offtake that Stephen's talked about. Look, I think some of the smaller communities that might be an issue, Kathy, but again, I know that's not much of an answer, but we haven't seen a lot of that. We sort of have a look at a project on a case-by-case basis based on where it is, and if we think there's some distortion, and that's something that Stephen mentioned before, and I know that's what Kathy's team does for a living, is we've got very strong relationships with Western Australia, Queensland and Northern Territory governments. They are regularly reaching out to us to get our views on, particularly on investments and what we're seeing. So if we see something in an opportunity that may be causing some distortion, we'd be wouldn't be shy in talking to the jurisdiction about that. That doesn't mean they might change it, but that's the sort of, we're very keen, and Stephen mentioned before, hopefully we can fund project, but if we can't, can we play another role to help that project be successful?
Okay, thank you. Craig, another one for you. There were a few questions about building materials and what influence we have over the building process and in relation to local sourcing. Your thoughts on that?
Yeah, very good question. That's something we definitely closely look at as part of our public benefit analysis. And, we won't get bogged down today, but it's around the FIFO, DIDO and the local content during construction and operations we look at very closely as part of our analysis. We also have a dedicated resource and we employ ITEs to go and have a look. We will not fund a project that we're not confident about the construction quality meets all approvals, local, state and federal. The construction standards, we will not be putting money into projects that don't stack up in terms of the quality, risk and meeting all requirements. We're very strict on that. We are very keen on local content, and it's something that we would talk strongly to the proponent about. Probably the only thing I will say, we're one part of a major group of people who make a project successful. We're not building it, but when we want to be involved, we do have some power with the terms and conditions that Stephen's team will offer where we can have some influence about local content. And I think I saw, Kathy, sorry to bog down, I think I saw something flash up about IES, and that's something that we really do push, and Kathy's team looks after that Indigenous engagement strategy between the proponent and the traditional owners where the project is something that we really focus heavily on procurement. So all our projects, which I think we've got 27 or 30 now, reach financial close. Kathy's team monitors the procurement targets that are using traditional owner content. We can do that on the local content, generating Indigenous jobs. And we're now looking at stronger pathways on top of that. It's not going to be just about procurement and jobs. It's going to be about graduates, traineeships and things like that. So we're really evolving in that space. We probably set the standard anyway. So that's something we're very keen on, the local content. It's something we closely look at.
Thank you. We're going to go to the online questions now. So thanks everyone that's put some in. I'll start with the ones that we got first off. What is the maximum loan? This is probably for you, Stephen. What is the maximum loan term, and does refinancing reset the clock? So you might need to obviously detail a bit about how refinancing works or doesn't at the moment. So over to you.
Okay, no, thanks. Look, so for the maximum term is very much linked to the nature of the project and what does the project require. So we don't give tenor just for the sake of it. We really look at, what's the nature of the project and the cash flows and what tenor does it need to be viable. So, from a purely, I guess, technical perspective, we can't lend longer than the 30-year Commonwealth bond. But, it's highly unlikely we'll see a project out to 30 years. I think in terms of like the Cairns housing project is a 20-year loan, and that was really to reflect the fact that, with the size of the cash flows and the cost of construction, that is what was required to amortise the debt to get our money back. I think it's important people stop thinking of us as offering a product and a set of terms. We work exactly the way around. So, if your project needs a 15-year loan, we can provide a 15-year. If it needs a 20-year loan, we can do that as well. But by the same token, if we look at the cash flow assessment and go, well, actually, it only needs a 10-year loan to be viable, then we won't give you a 15 or 20-year loan because, we're all about, providing loans or support that's fit for. I guess that's that one. In terms of the refinancing, currently we can't refinance our own loans. We're going through our statutory review, and it may be that one of the outcomes of that is that we get that ability. But as it currently stands, we can't refinance our own loans. So if a loan's to be refinanced, it needs to go into the commercial market, and we'll do an assessment of whether we think that that's viable based on debt to equity ratios and, et cetera. So again, very much project by project. But, I think what I can say is, we would need to see a project which can support the deleveraging to an extent that we think that end value is viable to get taken out in the commercial market.
Okay, thank you. Craig, has NAIF participated in any projects funded through the Housing Australia Future Fund facility as yet?
I think the Cairns housing, I think Stephen mentioned there was a grant which we counted as equity, which I think was in that slide that Stephen showed. That's the one we have done. A lot of the other projects that Stephen's team's looking at, there's definitely most of those proponents are seeking or have sought Housing Australia support, both either on the operating or the capital stack. So, look, I think it was a great, and I know there's a lot of collaboration now between us and Housing Australia. The Cairns deal was one that took a fair bit of effort to get over the line between all of us, but that created some good relationships now. So, yeah, look, I think a lot of those projects that we are seeing, that I think the Housing Australia in particular will play a role in where they can play under their mandate, Kathy.
Yeah, okay, thank you. Stephen, do you consider hybrid convertible to equity models? Sorry.
Yeah, absolutely. We can consider, all forms of capital. Obviously, it depends on how does what were the convertibility criteria as to how we would assess it. But yeah, we're very open to looking at alternative structures. So again, we don't have a one size fits all approach. We're really around looking at a particular project, looking at the risk of it, and I guess where the various risk pockets sit, and then making our assessment on that basis. So we can look at all sorts of, I won't say weird and wonderful structures, but that's probably not the right way of looking at it. But certainly, we're not bound to a, classic common equity plus senior debt model. We can look at, a number of various options in between.
Okay, thank you. Craig, on the Cairns housing project, what's the land ownership model under this development? Can you detail that?
Stephen, correct me if I get this wrong. It's Queensland Government owns the land. That's correct?
It was they provided a grant to help to purchase the land, but it's actually owned by the project company. So
yeah, sorry, that's right. Yeah, that's right.
Okay, and maybe this one for you too, Craig. Is there a minimum project cost or size that NAIF will consider?
Yeah, I think Stephen touched on it before. You won't find in our legislation or mandate a minimum amount. And I think, we've worked very hard over the last little while to try to lower that down. Typically, as Stephen touched on, a loan of around that 10 million, that's not the project size. Project size might be 15 to 20 is probably what we're looking at. Stephen touched on the Northern Territory infrastructure loans where it's a combination between us and Northern Territory Government. Their loans up to 5 million with, by exception, up to 10. So there is that in the Northern Territory. And I can assure you we've been working very hard to put something similar in with Western Australia and Queensland. And I'll take the opportunity with all these people on the call, Kathy, to watch this space in terms of our ability to play lower than 10 million in the coming next 6 to 12 months as an outcome of the statutory review. We hope that there's something that will come out of that will be able to look and offer products in that space as well.
Thank you. Stephen, what interest rates has NAIF applied for long-term loans between 10 and 20 years for 10 to 20 million?
Look, it all depends on what's the nature of the project. So I guess our starting point is we look at where the commercial market sits. So in the absence of any other factors, we would lend on the same terms as the commercial market in terms of an interest rate. So what we do is we look at the commercial market, we then make an adjustment for tenor. So if we, for instance, let's say there's a 5-year loan in the commercial market at 2% and somebody wants a 10-year loan, we would apply a tenor spread of between 10 and 15 points a year. So let's call that 12.5 per year for 5 years is 62.5 and just add that on. So that would be our starting point. We would then look at what's the impact of that interest rate on the financial model and the return to equity. And if it still gave an adequate return to equity, that would be our interest rate. If, however, the return to equity was reduced to such a level that we think the project's it's not viable, investors won't actually proceed at that level, that's when we can start to tweak, do we provide a discount on that margin? But as a starting point, we looked at the commercial market. So we're definitely not of the mindset of, we'll just give you cheap money because it's cheap money. It's really making sure that it's fit for purpose. So it may be in some instances it's commercial rates. It might be in some instances it's a small discount. However, if it's a project which delivers a lot of economic benefit and Indigenous outcomes, we might provide a very significant discount. I guess the bottom end is we have to cover our costs. So, we can't lend below the bond curve. And we also need to obviously, provide enough margin to cover our operational costs around that. So, we've had people approach us previously going, can we borrow money at 2%? And we've said, well, it's costing us, nearly 5% to get the money. So no. But yeah, it's very much fit for purpose, on a case by case basis.
Yeah. Okay. Thank you. Craig, this one for you, a question about how can we be so flexible? Does our legislation obviously set some boundaries? Or is it more that we look at a project case by case and then work with stakeholders to bring it to market?
Yeah, it's almost, thanks, Kathy, it's almost the latter. I think it's case by case. I will say, an absolute credit to our board. You're right, our legislation and mandate is very broad. You saw those 5 major criteria. I don't think you'll find too many other agencies that only have 5. I always say you could drive a truck through our mandate, but ultimately our board is the decision maker for our investment decisions. So we have to do a lot of work to convince our board that the risk that we're taking with taxpayers' money is worth that risk, noting everything Stephen just said. What's the Indigenous outcomes? What's the job creation? What's the public benefit? What does it mean for the community that's being built in, which we take into account. And then, it's around just making sure we can do that. I've got to say, the projects that we've brought to our board in the last 12 to 18 months, when I came here 3 years ago, I think the board would have thrown them back at Stephen and I. But, we're getting very good at understanding what the risks are, what it means for the community, what our public benefit analysis is, and the board's been very, very positive in supporting those projects that are high risk. I can guarantee they are. So we do look at it on a case-by-case basis, Katie.
Okay, thank you. This one for you, Craig. Would NAIF assist with funding to set up a modular factory in the NT?
Yep, I'll give you Stephen's mobile number and you can call him straight away. Yeah, look, and just on that, absolutely, manufacturing is definitely in our wheelhouse. I will also say there's the National Reconstruction Fund that is $15 billion that is also focused on manufacturing, and we've got strong relationships with all those other special investment agencies. We've got multiple projects with Export Finance Australia. We've got some with Housing Australia, CFC Arena. So, yeah, look, that's that classic example where Stephen said that, if a project is viable up there, NRF can do a bit of equity, which we struggle with. So it might be a project that we play the debt side, they play the equity side, and we can make something happen. So definitely come and talk to us.
Okay. One for you, Stephen. Would NAIF assist in loaning money to a trust?
We can look at a trust structure as part of a project, but no, our funding has to be directed towards infrastructure projects. So, it needs to be a direct correlation. Like we lend $1 and we see that dollar go into an infrastructure project. So we don't lend money to people on a sort of, corporate style basis where, we give you the money and then you do with it what you want. We need to demonstrate to our board that money is going to a project and actually quantify what's the public benefit, demonstrate the Indigenous outcomes. So all that needs to be set out clearly in our papers to the board. So the idea of lending to a trust on a just corporate style basis with no strings attached is not something that we can consider.
Okay, thank you, Craig. What happens if a proponent runs into difficulty post-construction and revenues are not as expected and loan repayment becomes unviable?
Yeah, thanks, Kathy. We've got a whole team that we've brought in-house for the last 3 years who looks after this. So Steve and his team's the front end. They do the deals, and then we've got a portfolio management team that looks after our proponents through the construction operations side and everything else. And, to Stephen's point before, our average loan's about 15 years. We are partners in these projects for long term. So we probably 1 or 2 years with the proponent before it gets to investment decision, and we could be with them for another 12, 13, 14, 15 years after that. So we treat that very seriously. We have some flexibility, understanding we're in the high risk space, and our portfolio team can have a look at the deferment of principal, deferment of interest, bullet payments, things like that, the amortization rate. We have some flexibility to have a look at that. Ultimately, if we get a project that has got real issues, we'd be working closely with the proponent and the other financiers to raise more equity, go to the market or find a solution to the problem. I think the key for us is we're not interested in getting a return from the project. We're interested in the project being there long term to create the jobs and everything else. So we've regularly gone in with other financiers who may have a more of a return based, and we're there to try to make sure the project's successful long term.
Thank you. Maybe one more for you, Craig. What is the key role of the Indigenous engagement strategy?
Should turn that around and ask you, Kathy. Or you can mark me and tell me when I get it wrong.
Okay.
Yeah, look, it's something that's been identified in Northern Australia when NAIF's legislation and mandate was first set up in 2016, that we don't want projects to come, get built, and then people run away, and there's no benefit to the Indigenous First Nations people on that land who have been there the long term. So we are extremely proud of our IES, and proponents should not be scared of it. It actually is very positive. Kathy's team, we've got quality people who know Northern Australia in this space who help facilitate the conversation between the proponent and the traditional owners to get a good outcome. We make that as part of our investment decision to the board to make sure that we get good outcomes from it. We measure it. So Kathy's team measures the outcomes through construction and operations, remembering that could be for 15 years. So, yeah, it's very important to us, but proponents should not be scared. Sometimes we get new people going, we're a bit worried about this, we don't know this space. Well, that's what Kathy's team's there for. We'll help work through, we'll help the relationships with the proponent and the traditional owners. We're ultimately there to leave them to their own devices. We're not going to tell traditional owners in Kununurra what they need, but what we can do is bring a lot of experience on what we've done elsewhere, what might be able to be done, what's best for that region. So it's we're very proud of IES, part of our mandate, and it's running very well. Kathy can rattle the numbers. I think we're over 1,200 jobs now just from our projects and must be getting up over $100 million of direct procurement spend. And that's a logarithmic growth because we're getting a lot more projects reaching financial close now.
Thanks, Craig. And that's A+ for you on that one. Would you look at this one's for you, Stephen. Would you look at a multiple project in one area town with a staged approach? That is, a project loan might start at $5 million and then grow to $30 million over time with the success of various stages.
Yeah, thanks, Kathy. And look, this is a really interesting one. Under our legislation, our board has to make an investment decision. And they have to make it based on a particular project. So we would generally, in that case, look at doing a loan for $30 million with a staged drawdown, but recognising that's not particularly efficient. If we did $5 million, they would then need to come back for a new investment decision and go through the process. So as it currently stands, it's certainly not impossible, but it's probably not the optimal solution. But I think what we would look to do in that case is actually say, well, is there some way that we can provide some level of concessionality so you can go straight to the $30 million? Because that's about bringing projects forward, getting people into homes, economic development, and that's if we can bring that forward through providing concessions, that's what we're all about, rather than sort of having to spread it out over time. And there's been a number of examples of projects we've worked with where that's exactly what's happened. I mean, the project probably would have eventually come to fruition, but it might have taken 3 or 5 or 8 years. By using our funding, they've been able to bring that project forward and get it running, get the shovels in the ground, I won't say quite today, but certainly much sooner. So that's something we can definitely look at. If somebody's got a project like that, please come and have a chat to us and we can identify whether there's something we can do to help, accelerate that project development.
Okay, thank you. Craig, this is from someone based in Katherine. They've got a small hotel and they would like to build more onto the hotel, I presume. It is hard to get a builder. If we build it ourselves, can we still apply for a loan?
Yes, you can. And definitely adding on new infrastructure, brownfield growth is fine. I think it's just some of those points that are asked and some of the other questions, Kathy, around the size. Yeah. Our legislation is very firm on anything over 4 million in terms of having that workplace health and safety accreditation. But the answer in principle is absolutely yes. We just need to make sure we'll do all our checks on, that everyone has the right approvals and everything else, which we mentioned before. But yeah, definitely something we could have a look at, Kathy. Yeah,
thanks, Craig. This one's a bit, I think this is maybe around personal loans. I'm not sure. I have an interest in urban consolidation in Alice Springs. The NT planning policy supports this. Is there any assistance for existing residents who own houses? I'm not sure. Did you want to take that one, Craig?
Happy to take the details and we can have a chat to that person if they want to do that. Look, an individual house loan is not something we do. In terms of, if somebody comes and talks to us about building 50 houses in Kununurra or Alice Springs as a developer, that's something we might be able to look at and all those other things we talked about. But in terms of an individual home loan, that's in that smaller space and not really where our area is. But again, if there's something we might be able to pass on contacts from somebody else in Northern Territory or elsewhere, give us a call.
Yeah. Okay, there's another one I might just send to you, Craig. What do you think are the barriers to investing in Aboriginal communities, and how will NAIF try to overcome this given the new policy agenda? I think this is more talking to being proponent-led, yes, or...
Yeah, I think we're definitely not the experts in this space. We haven't been able to have a lot of success in investment decisions for majority-owned Indigenous businesses or proponents, and something that we're really focused on. It's a KPI of ours as well. I know there will be a bit. Stay tuned. I think the task force and the statutory review report, when that's public, it has focused on that area and given us some suggestions of where NAIF should be able to help. But it's something we're very, very keen on, Kathy, to try to play in that space. Again, looking at the size and everything else. One of the areas that we also raised in NAIF's submission to the task force, which everyone will see because it's public, there is a real capability and capacity gap across Northern Australia generally, but we found particularly some First Nations proponents, it needs to be dealt with to make sure when we ask for a business model, they know we'll help as much as we can, and we do. We try to help our proponents through the process, but making sure there's that capacity to understand what we're asking for and why, and everything that we've also raised in our submission, Kathy, on. I'm not sure if it's NAIF to fix, but it's definitely something we're seeing in this space that we need to try to find a solution for as a whole of government type and territory government and jurisdiction. We need to find an answer to how we rectify that.
Okay, thank you. Stephen, can NAIF provide 100% project finance if required?
Short answer is no. So we're specifically excluded from taking all the financial risk in a project. We can't provide 100% financing. In terms of how high can we go, it really comes down again to that whole cash flow. One of the issues that we always need to look at, particularly in Northern Australia, is things like cost overruns. The days of a fixed price, fixed date contract are largely behind us. So we need to see that a proponent's got enough financial resources that if there are overruns or delays, that they can support those. I think we've mentioned a number of times, very happy to have a discussion around a particular project and what we think is viable. In terms of can we do 100%, no.
Okay. Can NAIF fund projects, Stephen, with residual property value exposure once the government subsidy ends?
In principle, yes, we can. I think that would really come down to an analysis of, what is that residual, where's the project located, what kind of project it is. Because, as you get more and more remote, the valuation or that terminal value becomes more and more uncertain. In principle, that's something we could have a look at. But I think in terms of specifics, would definitely be on a case-by-case basis.
Okay, another one for you. Will NAIF consider more than one infrastructure project proposal from the same proponent?
Yes.
Thank you. Are there sustainability requirements or regional climate adaptive parameters to maximise the benefit for Northern Australian residents? Did you want to take that one, Craig?
Oh, yeah, happy either way. The answer is yes. We look at social, the environmental side. We're under the same requirements in terms of proponent scope 1, 2, 3 emissions and all those targets. So they've got to meet definitely sustainability. We look at that very closely. We're in the renewable area space. We'd like to do more, but definitely something we have to include, and we do include as part of our assessment, Kathy.
Excellent. Another one, we're coming close to the end. With recent legislative changes to IBA that enable other government agencies and private sector institutions to invest in IBA for Indigenous projects, will we consider projects with IBA, housing projects, Indigenous housing projects, or Indigenous business, manufacturing, building materials, loans, those type of things?
Yes.
Thank you.
Yep, we're very, very keen. We were big supporters of that legislative change for IBA to allow to potentially access money from other agencies like us, that we could look at partnerships with them when it's something we'll definitely have a look at.
Stephen, this one is around Cairns housing. Can you talk more about the Cairns housing project and the build to rent approach and how the project came to life? So maybe around the rental return side.
Sure. So in terms of how the project came to life, it was I guess initiated by the Queensland government. They identified there was a need there and ran a process. Tetris Capital was ultimately successful in that. But in terms, it was really around they wanted to ultimately deliver some social and affordable housing, and they wanted to do it to obviously a high quality, but also minimising the cost to the state. So it was really around coming up with innovative solutions, and that's as Craig mentioned earlier, it's a modular build, being built in Victoria and shipped up, and that was really around, I guess, deliverability, addressing some of the issues around trades, etc. But in terms of the rent side of things, ultimately, those sort of social rents are set by legislation. It's a percentage of income. There's not really a lot of, I guess, movement on that. It was really around driving efficiencies and reducing risk in the overall project to reduce that government subsidy, which I guess was the key enabler of that project. So, in terms of the facilities maintenance and managing tenants, that's being done by CHL. They're very, very experienced. They've done enough projects and managed enough dwellings across the region that they could then sort of say, look, we're prepared to take on the risk around that facilities maintenance and occupancy. So that reduced that risk. In terms of the construction risk, it's being wrapped by the Spanish contractor as well, but reducing that by having the prefab. So it was really around trying to reduce as many risks as possible and then allocate those risks to the people who could manage them best. So there's a lot of parallels with, I guess, the public-private partnership model that we've seen across Australia. It's not actually a PPP, but I think in terms of trying to allocate the various risks to the various parties, there's certainly a lot of parallels there. So really interesting project, and one that's delivering some great outcomes already in terms of I guess demonstrating that these projects are achievable. I think that we talked earlier about a bit of a change in mindset. No one would ever have foreseen this project getting delivered 5 years ago. Going to go, it's Cairns, it's all too hard, blah blah blah. But ultimately, it got there, and there's a few teething issues along the way. I won't say it was the world's easiest project, but everyone rolled up their sleeves and got on with it, and we were able to deliver the project late last year. So.
Excellent. Thank you. Thanks, Stephen. Thanks, Craig. We might wrap up the Q&A there. Before we go today, for everyone online, I invite you to participate in a brief poll to gather feedback that will help us for future webinars that we run. Just click on the poll, which has popped up on the screen, to share your thoughts in 3 short questions. Alternatively, you can click on the poll across the top of the screen. It will only take about 30 seconds to complete. So there were some great questions today, and thank you to both Craig and Stephen for providing your insights. That brings us to the end of today's webinar. Remember, you can always reach out to us through our website, email, or by phoning our team for any further assistance. Thank you, everyone, for your time today, and look out for the email with the link to today's session, and we wish you a fantastic day ahead. Thank you, everyone.